SoFi reported their Q1 2022 earnings today, and we were supposed to get the earnings at 4 p.m. after the bell, but they actually leaked. We got them early at 11 a.m., which triggered a huge 19% drop in the stock intraday and a halt on the stock pending news that lasted about 2.5 hours. And overall, the whole situation was a little bit of a mess. In this video, I'm going to talk about those earnings and the impacts to SoFi's business. So SoFi beat on both the top and the bottom line, coming in at $321 million for revenue versus $287 million expected. EPS was pretty much in line with expectations at negative 14 cents. In fact, they even raised full year guidance from the 1.47 expected to 1.51 billion for a full year. So essentially a triple beat if you count for the guidance raise as well. And meanwhile, the stock is trading like the company's going to go out of business, which is why I think this earnings gave long-term investors a little bit of breathing room and reassurance that the company isn't going anywhere, that fundamentally it's sound. The reason why is because SoFi reported their third highest member growth, up 70% year over year on members, coming in at 3.9 million for the first quarter. They also reported their second highest ever product growth, 84% year over year, in large part driven by cross-buying opportunities, which increased 22%. And the cross-buying came from higher product satisfaction and overall a willingness to adopt new offerings. This is all part of SoFi's flywheel, their strategy that they're pushing, they're promoting the cross-selling opportunities across both their financial services segment and their lending segments as well. Now, if we break out the products by segment, we can see that financial services was up 111% year over year, and lending products were also up 20% year over year. This is the fourth straight quarter of accelerating growth for SoFi. If we look at their third segment, their technology platform, essentially this is Technisys, this is Galileo, this is all of their backend infrastructure of SoFi becoming the AWS of finance. This segment was also up 58% year over year in terms of accounts. You'll note that SoFi has three segments. They have their lending segment, their financial services segment, and their technology platform segment. And diving one level deeper, taking a look at each of their segments, starting off with lending, it was up 71% in terms of originations to 253 million in net revenue for Q1, which was driven by a record personal loan origination. And if we just look at the operations for the lending segment, if we subtract all of the expenses, the Q1 contribution profit was 133 million for the lending segment, up 51%. Now, if we look at the lending products, all three streams from a product perspective are growing, but they're not all growing from an originations perspective. You'll see that originations on average are up a total of 30% year over year, which is driven primarily by the personal loan originations, which came in at more than 2 billion in Q1, 151% year over year growth. This is more than double pre-pandemic 2019 averages. Student loans were flat, but they're down from the 1.5 billion from Q4 due to the loan moratorium being extended. Student loans being paused has been a big platform for Democrats, and it's been a big problem for SoFi because student loans is one of their biggest segments in terms of revenue. The company highlighted in their earnings that they believe that Biden will extend it again beyond August 2022, and they've adjusted their guidance to account for this scenario. So in the guidance that we're seeing, they've adjusted to account for student loans carrying over past August of 2022. You'll notice that home loans are also down. This has been affected by the rate environment, and still, despite all of these macro conditions, despite these segments, originations are still up 30% on aggregate if we blend all of those together. Now, if we pivot over to the technology platform, this is Galileo, this is Technisys, this is Pagaya, this is everything that's going into the back-end infrastructure. They booked 61 million in Q1, up 32% year over year. The contribution profit from this segment was 18 million, or a 16% increase. Management is investing a lot in terms of making this segment an end-to-end, fully integrated banking technology stack that can support multiple products through APIs. Note that this is going to be the backend that's going to be powering the entire banking space, existing large banks and new fintech companies alike. SoFi said in order to achieve this, to continue investing heavily in this segment, they're going to require this business, the technology platform business, to operate at a 20 to 30% contribution margin range for the foreseeable future. Finally, let's pivot over to their final segment, financial services. This segment came in at $23.5 million in Q1, up 264% year over year. And their financial services segment is quite new, which is why the growth is so fast. 264% year over year is quite rampant growth. And it's also why the expenses are so high for this segment. SoFi booked a $49 million loss in financial services. And the story here is similar to the technology platform segment, with the company investing a lot into this segment with no plans on reducing these expenses in the near future, because SoFi as a company is in that scaling phase of their growth. It's yielding results in terms of customer acquisition and in terms of financial services products, in terms of those cross-selling opportunities, but it's not really in a position where it wants to cut down on expenses to sacrifice that high level of growth. The aggregate of their financial services products growth is 111% year over year, 4.7 million products in total for that segment. The bank charter has really helped this financial services piece as well, as it allowed for new checking and saving account offerings to be at a super competitive rate, thereby making SoFi all the more attractive to prospective clients. Now, the best part of SoFi's earnings, in my opinion, I think, was the guidance. Management expected net revenue to come in at 330 to 340 million in Q2, so about a 39 to a 43% increase year over year, and they raised their full year guidance to 1.51 billion, up from 1.47 billion previously. Now, why is this important? Well, this is important because it's quite crazy to see, especially considering the macro environment with student loans, which they expected to be halted even past August 2022, and especially with the rate environment being what it is, all of this on a macro level is hurting SoFi as a lender. Meanwhile, SoFi is out here not only beating analyst expectations, but also raising their full year guidance when their biggest contributor to revenue, their student loans, is still on pause, right? And so this company just continues to outperform quarter after quarter after quarter. And meanwhile, the stock is continuing to plummet as if the company is going to go bankrupt. I mean, the stock just today was down 19% before they went into the halt. It recovered slightly towards the end of the day, but still ended the day, I think, like 10 or 11% down. And a lot of the critique with regards to SoFi right now is FUD around their bottom line, because SoFi is not profitable. They reported about $110 million net loss for this quarter. And I get that this is not the right direction that investors want to see, because they're burning money, which is not really the macro environment to do that, where investors will give you the benefit of the doubt. But what I will say about SoFi in their defense and in counter to that point is their adjusted EBITDA is positive on a trailing 12-month basis, and their revenue is still growing quite rapidly. So I'm not too concerned about SoFi's net loss, because they have a lot to compensate for that net loss, and they're inching closer and closer towards that bottom line profitability as a company. So to conclude this video, I think the numbers for SoFi were fantastic in terms of the growth. I'm very bullish on the company. They've been adjusted EBITDA positive for the last 12 months. Their burn rate is decreasing. Their net losses for this quarter at 110 million were much less than they were in Q1 of 2021 at 177 million negative. So their burn rate is decreasing, and profitability is the next natural progression into this. Plus, what I will say is, if you're trying to make a decision between investing in SoFi or not, and the net income losses are the thing holding you back, don't forget that you're getting well compensated for the risk that you're taking on for that bottom line, because the company is trading underneath their book value. They have about $12 billion in assets. Yes, they have $4.9 billion in debt, but their market cap is like 4.6 billion, 4.7 billion, and they're expecting to do 1.5 billion in full year 2022 revenue. I bought more SoFi today. I'm incredibly bullish on the company, and I'm personally going to be continuing to buy more SoFi. Of course, I will let you know if and when I do that, but for right now, I want to hear from you in the comments if the net losses are something that bothers you, if there's something in the earnings that I missed or that I'm misinterpreting wrong, and just present both sides of the argument with regards to SoFi, because for myself, I'm willing to give them the benefit of the doubt for many things in terms of their bottom line, for as long as and only if their growth is continuing at the pace that we expected as investors. And I think that for right now, it is. So we'll see how SoFi does in the remaining quarters of the year, especially with regards to the macro environment being what it is. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.